Happy Thursday, everyone. This is Rich Swerbinski with Onward and Upward Consulting and the Ohio Mortgage Bankers Association. The big picture back once again this week, sponsored by our great friends and partners at Depth, FinTech pioneer Carrie Milam, her outstanding EVPs, Leslie and Lindsay. Pros, the best in the biz. If you need your story told, help with strategic communication, brand management, public relations work, depthpr.com, or get a hold of Rob or I, and we will connect you with the fab team at Depth. So there we have it. Rob, as always, great to see you. How you doing this week, Rob?
I'm good. I can't believe we are, 2 weeks away from Thanksgiving already.
2 weeks away from Thanksgiving. Yeah.
Yep.
And we'll try to refrain from calling you name not available during the show today, Rob, but good to see you.
Please.
And this week back on the show, our good friend, been a couple of years, but really glad to have him back. He is the co-founder and CEO of Equity Prime Mortgage out of beautiful Atlanta, Georgia. It's our guy, Eddy Perez. Eddy, good to see you. Thanks for coming back on the show, brother.
My pleasure. Great to see you guys.
Love it. And as always, no shortage of news, Rob. I feel like I need to refresh the news feed, like every 5 or 10 minutes before the show goes live. And the government shutdown, of course, is over. The Democrats folded like a cheap tent. And then, in the mortgage world, some really wild news this week. I was cleaning my garage Sunday and just happened to look at my phone, and I just see things like smoke coming out of it with the 50-year fixed, people reacting and Pulte tweeting about the 50-year fixed rate mortgage. Since then, he's been really, Trump has leaked to the media that he was sold a bill of goods and wasn't happy about it. And then after that, we get the portable, assumable mortgage tweet from Pulte. And, at this point, Rob, I ask, we've gone back and forth on text on this. I feel like it's just when, not if, that Mark Calabria is back in this role, but maybe not. No, what's your thoughts on all this crazy?
No, I've actually swung toward your way of thinking, Rich, that Pulte's days are numbered. And the 50-year mortgage was I won't say denied, but Donald Trump said wasn't any big deal. I think his far right supporters said this is ridiculous. And so President Trump said, I'm not, this isn't, I don't see that going anywhere, frankly. I think anybody in capital markets says the same thing. I've talked to a number of my cronies in the secondary markets, and they're like, this is, that's nuts.
Real quick, because I want to level set, and it's important. If I remember, Rob, 20 years ago, there was a 40-year fixed rate mortgage that the GSEs rolled out. I want to say it demanded an extra quarter in yield, and nobody wanted it. I made a post on LinkedIn about this, not remembering this and fully, and trying to go down memory lane, not being able to find any Google stuff on it, and people seem to think that was the case, and that's kind of what makes it non-viable, right?
Well, you're really opening up a can of worms here. So Eddy, just stand by. So, I was, Rich, to tell you the truth, I saw this flash up on the screen, but, option arms, at some point, at some price, at some rate, people need to borrow money and people want to lend money, and used wisely, I would say that option arms wasn't like concocted by the devil.
Yeah.
If you look at maturities and just the basic economics of how a yield curve works, it's not like a 50-year mortgage is going to have the same rate as a 30-year mortgage or a 15-year mortgage. I know JMac, for one, has a 40-year mortgage. I haven't looked at those rates, but really, to rejigger the mortgage system in order to accommodate a 50-year mortgage. And I didn't look, but I remember reading something about a 30-year mortgage. The role of a 30-year mortgage was that, in theory, a borrower would, they graduate from college, they'd start working, they'd get a 30-year loan, it would be paid off in theory by the time they were retiring, and they would own their home free and clear. When you get into a 50-year mortgage, and I wrote about it in today's commentary, but there was a Babylon Bee piece about how grandkids are now, having to co-sign with their grandparents for a 50-year mortgage, right? It doesn't make any sense. And so Bill Pulte threw that out there, and then it was, President Trump said basically no, and the capital market said no, and it's a non-QM loan anyway, which is a different yield than QM loans, and so there we are. Now, I was talking to a Bill Pulte fan. They do exist out there.
The Mad Ishbia.
And no. What's that? Very
buddies, I know that.
So, and they were saying, well, at least Bill Pulte gets conversations going. At least he gets them going. And I said, well, that's kind of like President Trump talking about taking over Greenland. The conversation gets going. May not go anywhere, but the conversation. So Bill Pulte does get conversations going. When you talk about assumable mortgages, once again, as we all know, capital markets drive rate and price for the primary markets in mortgage banking. You're not going to originate, equity prime mortgage is not going to originate a loan that it can't sell, that there's no appetite for, there's no demand for. And so if you look at assumable mortgages, I'm not to say they are a bad thing necessarily, but you need to really think this out in terms of, if you are an investor buying a $500 million pool of Ginnie Mae's or conventional conforming loans, what are the reps and warrants? What are the amortizations like? Can you keep track of properties? Can you keep track of borrowers? What happens if a borrower leaves, sells a property? Can that borrower assume that mortgage? Who's going to underwrite that mortgage? Who's going to pay for underwriting that mortgage, and so forth and so on? It has a lot of implications. You just can't wave your magic wand and have these things happen. So, yeah, a lot going on, but I think that overall the main focus has been on the shutdown being kicked down the road to January. And so, with USDA and flood and so forth coming back online, I think that's where more lenders are focused right now. I don't know. I'm going to defer to Eddy in terms of where your originators' minds and eyes are focused right now in terms of what's going on. So what is going on out there in the trenches?
I mean, there was definitely a lot of talk about the 50. I don't think they, to your alluded to, understood some of the parameters, as it's not a qualified mortgage. So for the FHFA director, Pulte, to be able to offer that from Fannie and Freddie, that would require a lot of moving parts to change. I don't think they understood that. As well as, there's a couple of things. Obviously, the interest rates would have to be higher, and who would even want to buy those MBSs to offer that out there? So I think, to your guys' points, I think it was a great weekend headliner, but I don't really see any value there. Plus, I also personally think, I'm not sure if it's really, really good for the consumer. I had a friend that I talked to about it. He said, well, I'm worried where I live in this area, teachers and firemen can't afford to live. And I said, well, they do choose to live there. They could be a teacher or fireman somewhere else. And I know that that's a harsh way to go about it. I said, but they're picking to live in a very expensive area. If that's going to be their profession, maybe they need to take it to somewhere that's a little bit more rural or a little bit more smaller, and they could definitely afford to live. So, I mean, the big one.
Come to Cleveland.
Yeah.
I said, Rich, you'd have to live in Cleveland, man.
The big thing, the last thing I want to touch on before we really dig in with Eddy, with both you guys, is the Fed meeting coming up. I would argue this is the biggest Fed meeting ever, in my opinion, in terms of interest and implications. It's dead 50-50 now. If you look at the future Fed funds futures market, if there will be a cut or no. It's obviously very politically charged on both sides. It's the last cut of the year as we go into hopefully a calendar year that'll be more fortuitous for housing and real estate finance. So, Rob, I tee that up for you, and just to get your thoughts on maybe how you think things will play out. Will Powell just knowing he's kind of a few months out, kind of thumb his nose at the rate cut in Trump, or do you think he'll just do what he thinks is best? Or how do you think this will all play out with the December Fed final meeting of the year?
So we've got a couple months to go, right? Or no, I'm sorry, a month to go.
A month, dead month.
Jerome Powell famously said, something that everybody realized, and that was, if it's foggy, you slow down, right? And given the lack of federal news that come out, economic news, and apparently the continued lack of news because they've come out saying, well, we're not going to release that, and we're not going to release this, and so forth. The Fed, granted, each district has certain metrics and certain companies that supply them with information in their district that can be very useful in terms of gauging the job market, gauging inflation. So the Fed isn't necessarily flying blind, but there's no one out there that I've heard in quite some time saying the labor market is really healthy, regardless of what measure you look at. And so inflation is going to do what it's going to do. Apparently we're not going to get the consumer price index. So, we're flying a little bit blind, but I would say the economy is slow enough for Jerome Powell and everybody for them to vote to approve another quarter point cut. After that, who knows? But Eddy, I don't know Eddy, how long have you been in this business?
Coming up on 24 years.
24 years. Well, it used to be, Eddy, give you a little history lesson here. We didn't wait with bated breath about what the Fed was going to do. The focus has shifted, and now it's, certainly the personalities like Alan Greenspan or Ben Bernanke, Janet Yellen, Jerome Powell have shifted the role, and suddenly everyone, looks at the Fed and says, what are they going to do? What are they going to do? And so forth. And I keep telling them, hope is not a strategy. I know that's an overused statement, but when you talk to originators and good owners of good companies and CEOs of good company, they're like, the Fed is going to do what they're going to do. But I want my guys out there making 20 phone calls a day. I want them sending out 100 emails a day. I want them talking to realtors. I want them doing this, doing that, regardless of the rate environment. Do you have a problem with originators, your originators saying, well, I can hardly wait for the next Fed cut? That's going to help my business?
I agree with you. And I remember when I first was in the business, what the Fed didn't really matter. And they've cut rates for the last year, and interest rates really haven't done that much. So I think people should realize that it may not matter. I mean, it's good for the consumer that has credit card debt because that is going to get lowered on them, how those are tied. However, I think it's a colossal waste of time because Fed cuts rates may go up because of quantitative tightening, and they don't really understand how the mechanisms work too well. Like I said, they've cut rates, 5 times in the last year now? You go back to when they started last year, I think we're at 5 already. And I'm of the firm belief if it's 50-50, they'll cut. It's too close. I doubt some people will change their mind and be like, hey, let's not cut. Usually it'll be, all right, let's go ahead and just do it. So I think they will cut just because if the stats are saying 50-50, there's no way that's going to be a no. That's too close to a yes. At least that's my own opinion. That's my own thoughts, my own belief. But yeah, to Rob, I think it's a waste of time if originators spend time on that. That the Fed, I made a joke, just so you know, on social media, as soon as I saw it, because I was on my computer, the Fed rate cut came up, and I literally posted on social, oh my God, the Fed rate cut post will begin soon. And people died laughing all over. It's true. It's like, and then I would see the post from agents, from originators. I'm like, guys, that's a waste of time.
And if anything, I would argue, and I know Rich will bring in the fact that small business loans will improve as well. But if anything, it's almost it can be a plus or a minus for originator, because the originators are dealing with a public that sees these headlines as if the Fed sets mortgage rates. So they have to explain to their potential clients why the rates haven't done anything, and in fact may have even gone up. But it also, the plus side, it allows originators, this is something else I tell groups, it allows originators to remind their potential clients about why they are dealing with a person and not the internet, because they can explain why interest rates move and why interest rates don't move, and explain why the Fed doesn't set interest rates. And so they can be a person and walk their client through this stuff.
Yeah, it's a good point. You're both right. We haven't sat here and obsessed about what the Fed is going to do, even on this show the last 8-9 years. But But now I think the difference is it's been politicized, which people more charged up. And then, Eddie, would you not agree? If rates were to fall by like 30 basis points, like would volume double? And maybe not double, but it would be, I mean, I think most people feel like if rates come down by 30 basis points, that there would be a nice volume, you know?
I mean, there would be some new opportunities. However, I think the problem is everybody still thinks it's 2020 and 2021 when we did 14 million units. This year, the projections, 5.5 to 5.7 million units. If 30 basis points drop, what's that going to push us to next year? Maybe 6 million units? I think the problem is there's not enough refi inventory. The amount of people below 5% is a large portion of the MBS market out there. I'm not going to sit here and tell you that cash outs. Now, what I think will happen, I still think there will be continued amounts of second mortgage home equity lines that get taken out. So I definitely think that will continue because of, you're looking at, I don't know, you see the numbers out there. I don't know what's true, 20, 30 trillion in equity.
Mm-hmm.
And that's still a truckload.
Yeah.
I think you'll continue to see that. Will there be a couple people that refi? Sure. There'll be pockets, there'll be opportunities, there'll be boosts. But what everybody thinks that's going to come save them, it's not coming.
Yeah, I agree. I talked to a broker this morning and I asked the broker, I said, are things dead out there? And they said, yeah, people refinancing who might refinance are waiting for the next, Fed cut, right or wrong. They're just sitting on their hands. And so, hey, hopefully equity prime business is doing okay, but a lot of people are just kind of doing nothing. Maybe they'll do it after the holidays when they get all that 30% credit card debt. Yeah.
Yeah.
We're doing fine. And to your point, you bring up a great point. This is something that I've learned in the industry. We're about to come up to the date. Right around the 15th of November, I've always learned that so many people, consumers too, and I'm not even talking about just consumers and originators, will call it pretty much quits till January 15th, if not February 15th. The next 60 days, they're off doing anything but working. That's what I've always come to realize is that right before Thanksgiving and then right around MLK Day, all of a sudden, that time period, people really aren't going out there and hustling.
Yeah. And in the chat, my friend Jason Smith, 35 trillion in equity. And he would know. Jason Smith runs partnerships for depositories at Figure, the HELOC bros. So if anybody would know, it's them. So 35 trillion in equity. So
yep,
there you have that. Eddie, your company Equity Prime has been around a while. I remember you took which looks genius in hindsight because broker market share has gone crazy. I remember talking to you a few years ago about your decision to take the company 100% wholesale. In my head, I have to admit, I was like, man, going heads up with the Rockets and the UWMs of the world. But in hindsight, it seems like it was a really smart move. Brokers are now 25% of the market. I guess, yeah, talk about that move for your company and, what the last few years have been like and, and what 26 and beyond is looking like for EPM.
Sure. Yeah. At the time when we made the decision, because it was just a very simple cost model, the cost to originate a retail loan and distributed retail, because there's different, a lot of people use the word retail and there's a difference between consumer direct. There's a difference between distributed retail. There's a difference between, third-party originations. And sometimes they all get lumped together because in those third-party originations, you also got to look at non-del, which operates very similar to a broker. Yeah, it was just the cost to manufacture a wholesale loan was 70%, 75% less. It just made a lot more sense to go all in on that. And yeah, sure, there's some big players in there. However, this is always going to be and has been, at least for now, an originator game. Of course, originators are fluctuating more to third parties because they want the choice of freedom. They want to have different flexibility options. They want to be able to do business with 5, 7 different people. And I'm not saying that in, distributed retail that can't be done. However, it's more limited. Everything is in-house. And a lot of these loans are not as cookie cutter as they once were. So you do need definitely different options at the table and different people that you can take your customers to. So I think that that flexibility is what's going to keep it going. And when you look at it, I mean, it's 25 today. I think it's just going to keep going because every quarter, when you look at the originator numbers, you see more originators leaving one side for the other, and that will just keep picking up steam. The difference is they just have to learn that the wholesale model is completely different. You know, in retail, what retail does really good is they handle it all for you. You turn in the loan, you're done. In wholesale, you've got to carry a little bit more of the burden, but with that burden, you get a lot more. You have to have more self-responsibility, but you get a lot more flexibility if that's how you want to grow your model.
I will make the argument, Eddie, that if you take a good person who's got a retail team, maybe they own a retail company, maybe they're a division manager, regional manager, and you plunk them in correspondent, or you plunk them in wholesale, or you plunk them in direct to consumer. If I took you right now and made you do retail, or made you do, you know, direct to consumer, you would succeed. Because I would say that good people in the different channels can succeed.
Sure.
In other channels as well. Quick sideline question: are your parents in the business? Were they in the business?
No.
How did you get into mortgages?
I mean, it's always a funny story. When I graduated college, I became a stockbroker. As we know, 2001 happened, and that kind of the dot-com crash wiped it out. My dad was in construction, so I grew up around, you know, real estate and he was a residential contractor. So I grew around home ownership and what it can do for people. And I saw the first day of, you know, because he worked for contractors, he worked for builders. So I knew a little bit about it. And then it was rather simple. Somebody literally said, you should try out mortgages. I said, okay, what is it about? They told me, well, my husband's just started doing it. He's making X amount. He's talking to people. He's out there doing things, you know, doing business with these. Sounded like something that would interest me, that definitely fit my personality. I went to online. Well, first I went to the paper. That goes to show you when I did it. And then I also went online and I applied to a company that went down in 2007. It was on the implodometer. However, it was Consumer Direct that got me in the business and really cut my teeth and taught me how to really sell and how to really build value and how to build advisement. And then from there, I moved out. But yeah, that's how I got in. The dot-com crash. I'd studied finance. I had been around it enough. And I said, why not? Sounded like it'd be a personality for me. And yeah, that was 2002.
What was the name of the company that went down in 2007?
Home Capital.
Home Capital.
In Atlanta. It was I mean, I can say it now. They don't exist. It was a sweatshop. I mean, it really was. I mean, I'm just being honest. Like, but I taught a lot of what not to do and everything. Like it did, because I struggled through there to close, 5, 10 loans. Once I left out of there, I was like, oh, this is a breeze. It's a joke to close more than this. So it did teach me. It gave me the struggle muscles, that's for sure, in the industry, and really learned how to do it.
Yeah. Have you kept in touch with any of the people that you were with 18 years ago?
Oh yeah, there's still a few over the years. I mean, some are, the guy after I left Home Capital, I went to go work for. I think he's the COO now of Supreme Mortgage, Kevin Pisani.
Oh yeah, absolutely,
yeah. Yeah. So there's still some really some of the people that are from it that are still in it. Even the first person I ever hired when I went out on my own 20 years ago, I still talk to him here and there, and he works for Ameris Bank. So there's still a few of us left from that generation.
Well, I still make the argument. Sorry, Rich, we're going way off.
Yeah, no, all good. Yeah.
But my background is capital markets and secondary marketing. And then I was asked by Crossland Mortgage in the late 1990s to run a subprime company for them. So I started a subprime company. And you quickly run in with, we were selling loans to Ames and household and beneficial finance and so on and so forth. And it doesn't take long, and then they all went away. But what happened was the people that came out of Ames and household, beneficial, so forth, they know the business. they still know the business because they were having to go out and market themselves, get the borrowers, process the loans, underwrite, fund, service, collect. I mean, they knew the business soup to nuts. So those companies, that industry spawned a lot of talent that's still out there.
Yeah.
So
Very true.
This is The Big Picture, presented and sponsored by our great friends at depthpr.com. If you are a provider, fintech in the mortgage space that needs your story told better, strategic communication, brand management, PR services, depthpr.com. And Eddy, the competitive landscape in wholesale, it just fascinates me right now. It's, and you've got kind of like UWM is, and they've kind of got like their Death Star that they suck people under and make it really, really easy to do business with them. You got Rocket that is like the clear, like number 2. And it feels like every broker is either selling to one of those two, but you would know better than me. And I feel like that presents opportunities for, more innovative, more nimble companies like EPM. Sure. But if you could just assess the competitive landscape right now in wholesale from your seat.
Yeah, I think what people don't realize is this industry has become somewhat of a commodity. And I think that you have to kind of come to terms with that. And what I mean by that is, especially on the wholesale side, is, the old adage of good, fast, and cheap, pick 2. I think now in wholesale, you have to be all 3. And cheap meaning competitive within that 25, 50 basis points. So it has to be relative. So I'd say that you have to be more like Chick-fil-A, because Chick-fil-A is a little bit more than other fast food. However, it's like 10%, 20. It's not 100%. You can't be double the price. So I think that's what I mean, that it's still very affordable to eat at Chick-fil-A for a meal. Maybe not the healthiest, but that's your decision. It's on to you. My point is that with the industry being a commodity, especially on the wholesale side, because you've got to deliver every day. When I had my retail side, I remember the beginning of the month, I mean, literally retail originators, even the retail staff would be like, oh my God, it was such a hard month. Oh, and the first couple of days would be like coasting. It really would. Like they'd take 2 or 3 days off at the beginning of the month. Wholesale, you got to drive it every day. So every day is like game day. So that makes it even more into that commodity space. So you've got to be good. So in other words, your AEs and your staff have to be good. They've got to be knowledgeable. You got to be fast. I mean, your turn times and your speed has to be up there. And then, yes, you have to be competitive. It's no longer that you pick 2. You have to be all 3. And I think that's what really, to your point, Rich, is going to allow the growth out there. But yeah, there's plenty of opportunity. Plus, I still think more and more originators will continuously move into that space, especially when you're looking into how much non-Del is growing, because that non-Del space kind of gives them both. It kind of gives them the benefit of both worlds. It's like, yeah, they're a banker. However, they're still sending their loans off to be underwritten by someone else, but then it closes in their name. So it kind of gives that option that a lot of originators do not want to have to disclose the back end. And you don't have to in that way. And that's why you're seeing such an explosion there. Because as I always say, non-Del to me is broker with a line of credit. It's basically what it is to me. But it's still being underwritten and the risks are still getting taken. So you get a lot of risk transfer with a lot of benefits. And even pricing in non-Del is even a little bit better than wholesale. So you really have some competitive advantages. So I just think that the space is going to keep growing because originators are going to keep growing it. And go from there.
Eddy, how much time do you spend now working with brokers or being called in by your accounting? I mean, hey, help me out here, help me out there.
Me personally, not much.
Not much.
I don't get into the loan level details. Now, that doesn't mean that I won't get a message on Facebook from somebody about a loan level question, even though we've made it very clear what the chain of commands are. Because if they come to me on something, I'm just going to my COO. I'm not the one that's going to go in. I purposely, made them change my username and password in the system, so I don't even know how to get into it. On purpose, I did that. That's what you have executives for. That's what you have management for. That's what you have leaders for. But yeah, Rob, I mean, I'd probably get sucked into 20 or 30, if I did. At one point in time, I used to, on every employee's email at the bottom of them, if you ever have a comment, please send an email to me. That sounded like a great idea. And then it was like 50 to 100 a day. Very few had real validity. And then the joke was around here that people would weaponize it. And then they would write to some of the people saying they're going to send an email to Eddy. And I know Eddy very well. And they would spell my name Eddie, which was always a joke here because I don't spell it that way, when people knew exactly that that was just a bait technique. So I don't really get a whole lot of the loan level situations. I will say that the team, the management team, the leadership team does handle a lot of that in a pretty good manner.
So do you think that to the extent that you do deal with brokers, do you think the broker mentality has changed over the years? Do you think that brokers' focus has changed over the years, or is it relatively constant? And if you could succeed in 2015, you could succeed now doing wholesale?
I mean, I do think it's the latter, not the former. I mean, what has changed a little bit is they are more into branding themselves and really growing their own brand to try to get business that way, to become a little bit more of a subject matter expert. However, yes, I think if you could succeed 10 years ago in wholesale, I think it's even easier today to succeed in wholesale.
Interesting. Because of the technology?
You got the technology, bigger market share, so there's more opportunity, more acceptance. You know, even 10 years ago, it still was not that far from the financial crash, and people didn't want to deal with the broker. And I'm even talking about how much business brokers could get because agents and builders didn't want to give them business. So reputation has improved.
Yeah. What about leadership, Eddy? You speak on leadership more on social and LinkedIn as much as any of the great leaders in our industry. I would love to just get your thoughts on leadership in general right now in the mortgage industry, like what it takes to win. Your thoughts on leadership in mortgage in 2025.
I could probably get in a lot of trouble being controversial here. I think there's
there's only a handful of people who watch the show, Eddy.
If you want to take shots at any of your competitors, it's great for our rating.
I worry about my four walls, not anybody else. No, I think there's a certain old guard of the industry, and it has nothing to do with age. I want to be very clear when I say that. It has to do with that mindset that what worked from 2008 to 22 isn't going to work anymore. Because that was an era of quantitative easing. And a lot of people don't understand that. That was an era that interest rates were bought down. Everybody keeps talking about how this is a hard market. I'm so exhausted. This is a very normal rated market like when I got into. We never saw rates in the 4, 3s, or 2s till quantitative easing. Never saw it the first 6 years of my career. Then the Fed gets involved. And I think, we were talking about it earlier, why the Fed's so watched now. Because cutting interest rates isn't what they just do anymore. It was quantitative easing. It was quantitative tightening. They've really gone above and beyond. They've gotten really further into the weeds, as I would say. So, I just think there's and you have these people who keep saying there's going to be a refi boom, and we were talking about it earlier. As Jason Smith said, 35 trillion in equity. I do see cash outs from people that didn't refi. I see still the biggest opportunity in seconds and lines of credit, because even if somebody's credit's been a little bit hit, non-QM has second mortgages if the LTV are low enough that can really do that, and they're better than refinancing the whole first and all that. I just think there has to be a morphing. I think people need to understand that this industry is getting disrupted, but it's not just by AI and tech. It's also that more and more jobs are getting moved overseas and offshore. And the reason I say that is people aren't doing that for cost. As crazy as it sounds, I tell people that they're doing it for culture. Because if you study how Detroit, the big three, got disrupted by Toyota, it's the same story you see today. Oh, the American worker didn't care about quality. Their comp was too high. And I've said this over and over and over again. After 2020 and 2021, sales is kind of adjusted to the new comp. However, operations, compliance, and all those teams have not. I mean, they still are thoroughly upset why they're not getting paid as much as they did in those time frames. And I remember years ago talking to some of the people, I said, the way this ops is going to get disrupted and replaced by tech, AI, and offshoring, because at some point in time, companies are just going to they're just going to say enough is enough. And you're seeing a lot of companies, names that I won't name here, who have thousands of people overseas now and has reduced their footprint of the American worker. Because also another problem that you have out there is you have so many companies, and it was talked about all over the industry, where, you know, former employees are just suing them for overtime this and that and really exploiting it. So what do you expect? It's what's really going to disrupt the market in that old guard. And that's why I say the new guard is a lot of these people have led to their own demise. And I don't say that with any joy. I say that actually with a lot of sadness. Is how did these people not have a problem in their comp in 2019, yet they've got a problem today? And I know the argument's going to be, oh, inflation's higher. Yeah, but production in this industry is like late 90s, early 2000 units.
Mhm.
How, and margins have been compressed. You know, the volume is what everybody likes to throw out, but volume's so much higher because loan amounts are double. It has nothing to do with units. So I think from a leadership standpoint, I think there's a lot of bitter pills that have to get swallowed. And unfortunately, I see a lot of the operational roles, a lot of roles being diminished either by tech, automation, AI, or offshoring. And that's not changing. I already know companies that have so much of their entire back office, underwriting as much as they can, closing, even processing in the Philippines and areas like that. And I don't think that's going to stop. And the only added benefit is, yeah, they save money, but that's not why they did it. They did it because a lot of the American workers in that side of the equation just have become intolerable.
Well, Eddy, that wasn't too controversial. So thank you. And then regarding Rich's comments about, you know, we'll do anything for ratings. Eddy, fortunately, you weren't here on a clothing optional Thursday. Occasionally, Rich has, you know, pulls a clothing optional feature.
I wear collared shirt and a pullover sweater for Eddy. You say, you know, I mean,
I even wore a sweater. I'm not even in a t-shirt for you guys.
This is the big picture. We are joined this week by Equity Prime Mortgage's co-founder and CEO, Eddy Perez. Eddy, you made some comments recently on social mortgage media. They got some people's attention. I agree with you, quite frankly, that still some more consolidation to come in the industry. You're like me, never one to shy away from a good take. But yeah, your thoughts on, you know, your comments and you know, consolidation in the industry this next year or so.
I mean, I just think more and more has to happen. You know, I think more and more will happen because you're also, I mean, I even heard it at, where was I at? Austin this past year at MBA, IMB. More and more people talking about consolidation and more companies buying or taking over the companies. And you've seen it. It's been all over the press. And I think you'll see more and more because I think a lot of people are just winding down the businesses, you know, and just not really into it anymore. You know, they said, all right, you know, after 2020 and 2021, all right, 2022 was a little tough. I'm gonna hold on to 2023. Then in 2023, it was survive till 25. I don't even know what the saying is now. I don't know. Let's get it in 26. Who knows? And it's like every next year, it's like every conference I go to, it's like, oh, no. I'm really looking forward to next year. And what they don't realize is if you just look at the data that the NBA puts out about units, that really tells you what you need to know. And that's it. Like, it's the magic pill's not coming. You know, I think people need to realize that nobody's coming to save them except for themselves.
You raise a great point there. I mean, when you go to a conference, nobody, you know, I don't saddle up to you and say, hey, how was your profitability last year? Or how many units did you do last year? It's always, hey, how much did you do? It's a volume based thing. And that's, you know, that's not as it should be because it is a unit game.
Yeah.
So whether your staff is doing 5 units or whether a loan officer does 5 units for 250,000 or 5 units for, you know, 2 million, kind of the same amount of work oftentimes.
Well, nobody bills you differently. That's why I always say, you know, your LOS's profile is based off a unit, not off a loan size. You know, so much is based off units. You know, the warehouse lines, when you lend it out, the wire fees are not per volume, it's per unit of output. So I think that's what people don't really look into. And to your point, like you're saying, Rob, you know, I'd almost take an organization that may do a lot more units, but their loan amounts are smaller. Because what I've also found is with a little bit of smaller loan sizes, if you're servicing, your runoff is a lot lower.
Mhm.
So in other words, you get to retain your portfolio even better because runoff is lower. So I'd almost tell you from a business model, it'd almost be better to have, the upper 2s to mid 3 loan amounts versus mid 4s to 500. I'd almost tell you it's a better model for you just from a sustainability of the future.
Yeah, we see that in the capital markets in terms of specified pools. Smaller pools made up of smaller loan amounts, when you slice and dice them, often command a premium for exactly that reason. A quarter point move might mean, $30 a month. Well, do you really want to spend thousands to save $30 a month? No. So the loan stays on the books longer.
Yep.
Eddy, your broader read on the industry as we head into 26, regulatory pressure, margin compression, talent trends. We hear a lot just from the field that the regulatory and compliance, people are just seeing a lot of different stuff out there. The people's mortgage companies' interpretation of compliance just wildly different, which I can attest. But we'd just love to get your thoughts on some of those moving parts as we get into the end of the year here.
I mean, I think with the current administration, there's probably a little bit of some Wild Wild West, a little bit, not a lot, but a little bit. What I don't think people need to realize is what happens if administrations change in 28.
Right.
They're not going to care that the prior one was Wild Wild West a little
We
bit.
could bring back Rich Cordray. You never know.
I don't think people really understand that you probably need to follow it, to a good interpretation because it's what's going to last you. Just like, what we were talking about earlier, that the Fed doesn't dictate rates. Political parties shouldn't dictate your compliance.
Yeah, that's right. Yeah, I agree 100%. And Rich, when you talk about, these wild swings, I hear more in terms of loan officers asking about point banks or asking about this, asking about that. I don't hear that from CEOs and owners of companies, senior management. I mean, they know, to Eddy's point, things change and the rules still exist and we may as well adhere to them.
Yeah.
Hold on real quick. I got to adjust this light. My God, you can tell the sun's changing an angle here.
I haven't seen the sun in like in 10 or 12 days. So I was actually enjoying it. But
it's just a big round thing in the sky, Rich. It's
there it is. Now I'm back. I'm not as shiny as I was.
Snows in the
Rich,
ground.
here's your trivia for the day.
Mm-hmm.
Did you know when you look up at the sky that the sun and the moon are pretty close to exactly the same size?
Yeah, it's that we haven't seen either here in Cleveland for a week or so, but I would welcome the ball of light in the sky.
You're not out there looking for the aurora borealis?
It was here actually. My girlfriend was showing me pictures of it. It was like somewhere very close to us, and maybe not the aurora borealis, but some incredibly cool sky.
The Northern Lights, yeah.
Yeah, exactly. So
I speak Latin, Rich, so that's why I use the term aurora borealis. I didn't mean to derail the conversation.
All good. Just a couple minutes left with Eddy Perez of Equity Prime Mortgage. Eddy, what else you've seen in the marketplace? Anything that is catching your attention, just as the CEO of
arms. I have seen a huge pickup in arms.
Yep.
This is the biggest. I think right now it's about 11 to 12% of the business, especially in the first-time home buyer on the Govy side. I'm not going to see pre-08 when it was a third of arms, but I would not doubt if 20 to 25% of arms on the first-time home buyer Govy side do not happen. And to be honest with you, it's actually a pretty good loan. If you look at the starting interest rates, it's better than the 2-1 buy downs. I'll tell you that much. And if you look at the starting rate on a 5-1 and the caps are 1.15 and how much it's like 1.5%, 2% lower than the current prevailing rates, somewhere in that ballpark, even if it adjusts in year 6, it's still better than if you had had a 30-year the whole time. Now, when you're telling me a first-time home buyer, yeah, only 6-7 years in their house is a huge possibility because a lot of time a first-time home buyer will have more kids and then looking for a different school district. So that is one thing that I've seen a huge uptick. I mean, and you even saw a huge uptick, just to give it some color, of 25% just last month in MBSs. It went from 300 million that was securitized, which doesn't sound like a lot, to 400 million. Well, once this picks steam, it'll be billions a month that gets done. I do believe, and it was something I was alluding to earlier when Rob was asking me, and then we got off our subjects here and there, is I do see a lot of originators now really understanding the arms, and they're really coming back on the, FHA and VA side. And I think that is one of the big things that is definitely going to affect in a positive way affordability.
It's a great point. On a 5/1 arm, the first 6 years blended saves so much money. Honestly, if you got a refi, I mean, my last lender job, I remember we just sold the living crap out of a 5/5 arm that I had convinced the bank to put in the portfolio. That was really, really strong against 30-year. And great point. Yeah, and arms ticking up. Rob, the GSE's arms, like, it's been forever. Could that maybe that's the next Bill Pulte idea, the 1/1 arm.
Fannie Mae and Freddie
That
Mac.
might be it. I honestly, I don't want to joke. That could be his next tweet.
Since I've been in this business, Rich, 40 years, the Fannie Mae and Freddie Mac have never had a competitive arm product. And woe to originators who work for companies that sell loans to Fannie Mae or Freddie Mac, because they're competing with nimble mortgage brokers or credit unions or banks that have these portfolio products that are much better priced than they are, because they're selling to Fannie Mae and Freddie Mac, and their arm offerings just have never been remarkable.
Yeah, good point. Well, this was great. As always, the time flies by. A lot of love for Eddy in the chat, just with his honest and insightful takes. And Eddy, thanks again for coming back on. We'll certainly have you back on. And enjoyed getting your perspective on our wild and wacky industry. So
I love it.
Thank you.
Thanks, guys. I appreciate it.
And
to
our attendees, thank you all very much for taking part of your Thursday out with us. If you're listening on pod or watching on YouTube, where most of you consume it, we do the show live. We every week between 150, 200 in here live. It's a lot of fun. Go to CrismanCommentary.com to get signed up for the live. And and we'll be back at you next Thursday at 3. Have a great rest of the week and weekend, everybody. And thanks again, Eddy.
Yeah, my pleasure.
Thank you, Jeff.
Take care, guys.